We are delighted to welcome our distinguished keynote speaker, Krish, who is Vice President of Global Commercial Risk Decision Science at American Express. Krish joined American Express in 2002 and has held responsibilities in fraud and credit risk management teams across consumer and commercial portfolios globally. In the last 5+ years, his team has driven several data science innovations and modeling enhancements to transform commercial risk models for American Express. He is passionate about data science and machine learning, and over the last decade has played a leadership role in adopting of machine learning in risk decisions within American Express. He's a voting member of several risk committees with American Express and leads the Talent Acquisition for India Center of Excellence. Krish is also an Amex appointed board member of the Small Business Financial Exchange. He holds an MBA in finance and a bachelor's degree in chemical engineering. Please join us in extending a warm welcome to the very accomplished Krish.
Thanks for the kind introduction. A very good morning to everyone. Over the next 30 minutes, I'll try to explain to the audience on how the risk landscape changed during the pandemic and post-pandemic, and how it accelerated the AI ML innovation in financial services using American Express as a case study. So let's get started. I think I was already introduced. Probably the only thing I'll talk about is my role. What I do in American Express currently is I head the predictive modeling group for managing credit risk for all our commercial portfolios globally. It's a fascinating problem. I've been in this role for the last 6-7 years, and every day I am extremely excited to do this job for the following reasons. One, American Express is a leader in payments in credit cards, especially in lending, providing unsecured lending to commercial businesses. So we deal with small businesses to very large corporates. We provide unsecured lending of large dollar amounts ranging from $10,000 to millions of dollars. Most of these decisions are instant and automated, powered by AI and ML. And it is backed by data, which is very disparate. So when you think of predicting risk for a commercial business, you have to think of various aspects, from bureaus, from transaction data to documents like financial statements and bank statements. So as a data science engineer or a head of predictive modeling, it's a very challenging problem to solve, and it keeps me energized every day, day in and day out, for the last several years now. Along the way, I think the last decade or so, I have become extremely passionate about data and machine learning. I normally preach to my young junior colleagues to say that torture the data to make it conscious, and I strive to do that day in and day out. And the other thing I've spent a lot of time in the last 10 years or so is to groom the young talent within the company. With that brief introductions, I will probably touch upon American Express. American Express is a global company. I presume most of the audience have American Express card in their wallets. So what you know is that a global company, we have more than 130 million card members. We generate 50 billion of revenue. We're extremely profitable. Our ROE is 33%, and we have sustained it for a long duration of time. But the important thing I want to let the audience know is that it's an extremely data-driven company, where data drives our decisioning, be it in marketing, be it in risk, be it in servicing. Day in and day out, data plays a significant role. Through our payment network, almost $1 trillion of charges go through every year. You can visualize this as 7 billion transactions. And for every transaction which goes through our network using our cards, we do real-time decisioning using AI and ML to solve many problems, solving credit risk, solving fraud risk, thinking about marketing offers. Everything happens real-time through all this transaction data which we process every day. It's backed by a strong colleague base of 77,000 colleagues spread across. We are present in more than 120 countries. As I said, data machine learning is central to American Express, and it's led by a group called Decision Science Group, which is what I am part of. We have an elite colleague base of 700 colleagues who are of very high pedigree with masters in engineering, statistics, economics, management, and they are spread across India, US, and Singapore. India is the epicenter of this group, and we solve the problems for the company sitting out of India. Two things you should know about Amex is that it's known for its customer service, and one of the ways we measure ourselves is what kind of industry recognition do we get. So if you look at US JD Power, is an award which is given as a benchmark of the best companies in various verticals through the voice of the customer. It's an award which we have been winning regularly. We are #1 in credit card satisfaction survey. For the 4th year in a row, we have been #1. The awards was announced earlier this week, and we have retained our #1 position. The other aspect which is fascinating about Amex is that it's a very strong employer base. We are recognized for one of the great companies to work on, and this year we are #3 in the list in the US. So with that background, I think let's move on to the topic. First, I want to set the stage in terms of, for someone who is outside of financial services industry, how does the risk landscape changed? How did it change during the pandemic, and how it is changing post-pandemic? So let's just go back in time. The first thing I would say is in 2020, we all know that the pandemic struck. I still distinctly remember being in office on March 2020 when we decided as a company that we are going to make a switch from working from office to working from home and making it virtual. It's a change. It's a beginning of a large change which we didn't anticipate in terms of the duration and the extent and the intensity. So what happened obviously is, as consumers, we went out less of our homes, we reduced our spendings, we became more discretionary in our spendings. Many businesses, especially small businesses, had struggled in terms of surviving through this crisis, and many of them are shut down. So for a risk manager working in a financial services, solving for unsecured lending, the viewpoint we carried is that we are expecting a record loss in the industry. The last recession happened in 2008. And over the next 12 years, at different points in time, we were predicting that some downturn will come. But this was the event we were thinking that it's going to have an enormous impact on the industry, and it's going to have a lot of credit losses across the industry and issuers. But what happened is the entire world responded to COVID. Most importantly, governments across the world responded to it through stimulus they were able to provide by direct transfers to individuals and businesses. I'm going to base my entire talk around focusing on US as a market and commercial as a business. How do you manage credit risk for commercial? That's the central theme I'm going to use to talk through. So what happened in the US obviously was they did pass this COVID relief funds to support businesses to pay the payroll for their employees. They came up with a paycheck protection program called PPP loans, where they gave loans to businesses with less interest and relaxed payments for a duration of time, and they were willing to forgive if they were to use it for paycheck protection. So there was enormous liquidity in the system, both for individuals and businesses, and the outcome of that was that the anticipation we had that losses will increase actually didn't happen. There was enough liquidity in the system, both for businesses and individuals, so they were able to make payments on their outstandings in loans and mortgages. The other thing which also happened is that many of the credit providers came up with relief programs for the consumer, because when you go through crisis, what differentiates a great company from a good company is how do you back your customers. And Amex was one of the earlier ones to say that we are going to back our customers by providing flexible payment options. So given the liquidity, I think, and the payment options, the actual risk we saw was much lower than what we anticipated, which was completely surprising to us. And the outcome was, you would have seen in the street that many companies showed record profits because their losses were low. Even though the revenues were getting lower than the pre-COVID levels, but the losses were low, that they become more profitable. And the headlines is what you see, and the overall credit debt was going down. But as we went to 2021 and early part of 22, things began to change. Many of these relief programs started ending. Many of the forgiveness we had in student loans started tapering off. Consumers and businesses were able to come out of their homes and do travel, do business spend, try to grow their business. So because of that, the discretionary and non-discretionary spending started increasing, and the outcome was the consumer debt and the business debt was growing. For US, the debt levels were going to a high share of GDP. And what was happening was consumers and businesses were falling behind on the payments, and the outcome was an increase in delinquencies. So the way the trajectory was going, it was becoming a concern, and the question we had was that, is this going to be higher than pre-COVID levels? Is the slope going to be very different to what we have seen in the past? And are we looking at a possible recession in 2023 or early 2024? So that's the backdrop of events which happened. And the question comes in, as a risk manager or a head of predictive analytics, what challenges does it pose for you and what opportunities it poses for you? So let me start first with the challenge. The challenge is that the data imperfections it created in 2020 and 2021 is something it dawned on us in terms of what was changing. So let's focus on the left side of the slide. I think the thing you should understand is when you issue, so let's say we issue new cards to a book of applicants, the normal credit curve of what you will see is that there'll be an increase in delinquencies in the initial few months. Then as time passes by, say 18 to 24 months, you will see some seasoning of this curve and some maturity, because defaulters will get weeded out, and who survive the first 18-20 months are better in credit worthiness. And normally what you will see is risk will reverse to the mean portfolio default rate of any issuer. So that's the standard credit curve you will see. But when we look at 2021 and 2022, there was an enormous distortion. First is we didn't see the curve. We didn't see this shape of this curve. We didn't see the slope of this curve. And the level of the risk we saw was obviously metered because of the increased liquidity. But as 2022 passed by and as we move towards the end of 2022, we saw there's a clear uptick in delinquencies. So now we are seeing a delayed increase in delinquencies across time. So, the cumulative default rates may end up being higher or similar to pre-COVID levels, but the shape of this entire curve has got distorted. Okay, what it means for predictive modeling, because normally when you try to predict for default, you will pick an historical data and you will try to see what's the relationship between an independent variable and a dependent variable, and you try to build a machine learning model. But what was happening is there was distortions in the data. For example, during the peak of COVID, governments and issuers said that there is no penalty for missed payments. We were giving you payment holidays for certain periods. So what it means is you will see customer not paying a payment, but that doesn't translate into a default, which in an historical time period, you will see that happening. So there was a fundamental shift in the relationship between independent and dependent variables, which posed a challenging scenario for a predictive modeling person. The other aspects were opportunities which came in. I think the first one is the rise of alternative data. Let's take the example of business. Business, we provide lending. And when we provide lending, we look at financial statements like a balance sheet or P&L. When you go through a systemic risk or a distortion like COVID, some of those data becomes outdated. So what you want is live and real-time data and relevant data. And one of them, which was very powerful, was bank statements. So the opportunities is we as a company and as a financial services industry had to quickly innovate to say, how do we capture financial bank statements and how do we derive intelligence from this data? And then how do you use it for real-time decisioning? So that's the opportunity we had. The other aspect was the spurt of new products which came in. So you have to understand, what does a PPP loan do to a customer behavior? What does buy now pay later kind of products do to a credit curves? Those are aspects which change the customer behavior and change the trend of risk. So those are challenges and opportunities we had ahead of us. So what I'll do the next 10 minutes is to show is in terms of what evolution in data science and machine learning happened and how innovation actually accelerated because of these distortions which we saw. So I'll say on three aspects. The first one is transformation in how we do predictive modeling. And the key question we had to solve is, how do we cope up with rapidly changing credit trends? The second question is, how do you augment your traditional data like credit bureau data or transaction data with new type of intelligence from bank statements or raw trail line data, where it requires enhanced application of AI and ML to derive intelligence? And third aspect is, how do you take detailed time series data and derive quality intel from this alternate data using machine learning techniques like transformers and RNN. So those are three themes I will talk about, and that's where the innovation happened in financial services. The first one is about how do you respond to rapid changing trends in credit. So normally, as I said, when you do predictive modeling, for example, you say, I want to predict the default risk of a business in the next 18 months. You will normally take a data which is 18 months old and you will try to do the predictive modeling. But let's say you're standing in 2022, if you were to use your 2020 data, you will have a lot of blind spots in the level of risk in the relationship between independent and dependent variables. So the challenge was, how do you use pre-COVID data, but make the pre-COVID data adapt to the new trends which is happening in post-COVID data? Okay, which is where a traditional industry technique is survival modeling, which is that you break a long-term prediction into components to say that I can break an 18-month prediction into a 6-month prediction. I can look at which customers survived the first 6 months and then predict who is likely to default in the next 6 months, and then look at a time t equal to 12 to say who defaulted and who survived and who is likely to default in the next 18 months. So you can break an 18-month prediction model into components, and then the smart thing we had to do is how to combine survival modeling approach along with the machine learning approach like an XGBoost or random forest, such that the outcome in the models is one, it preserves some of the core credit trends in pre-COVID, which we believe some of them will reverse too, but it captures the changes in trends during COVID and post-COVID in short-term data, and the short-term intelligence actually feeds into the long-term prediction. So that's a fundamental shift we made in our predictive modeling, and the way for us to illustrate what is the value of this exercise, I'll talk through the slide. What you see on the slide is on the x-axis is the credit default rates across various quarters from 2021 to 2022. So as you can see, the blue line, the light blue line is the line which shows the credit default rates. What you see is the level of risk did increase across time. If you were to build a model using just historical pre-COVID data, those models would behave like the way we have the dark gray line, which is that they will respond to some aspect of the increasing risk, but the models should not be able to fully capture the drift in the level of risk, and hence there will be an issues in model accuracy. So when you combine survival modeling with machine learning techniques like XGBoost, what happens is you are better able to capture the drift, and some of the model accuracies gets reduced significantly, such that we can provide superior customer experience while managing credit losses. So that's the first problem we solved. The second problem is around how do you introduce new intelligence and how do you derive more intelligence from this data. So I'm going to use the example of bank statements. Okay, I think there was a spurt of this process to say that we will collect bank statements in the fintechs and financial services industry because it provides real-time and view on short-term liquidity of a business or a consumer. So, but the challenge which it poses is it's a document which is a native PDF or it's a scanned document. How do you capture intelligence from them, and how do you convert them into intelligence, and how do you real-time provide this inputs for a real-time modeling which makes decisions in milliseconds. So that's the fundamental problem we had in terms of both the intelligence to derive and how do you automate to make this real-time decisions. So I think that this slide basically summarizes the architecture we follow, which is that you can gather bank statements from a customer in a systematic process. You will go through traditional methods of how to spread this bank statement into raw transaction structured data. Then you will bring in the human in the loop to say there are experts who will classify these bank transactions into and label them in terms of what kind of record it is. It's easy for you to do this for a consumer bank account, but when you think of commercial bank account, that's a big opportunity which is there in the industry, that how do you differentiate a credit transaction as a revenue or sales vis-a-vis a cash inflow which is coming in because of some payments by one of the suppliers. So so that's where transaction classification plays a big role, and techniques like NLP is a fuel which makes this happen. So you go through this iterative process of how do you classify this better and learn this better by relabeling such that you can do the following better. One is how do you assess risk from bank statements? How can you estimate the sales and revenue of a business? Can you infer on the cash flows of a business so that you can decide on what does the liquidity going to be look like for short-term unsecured lending? And just to illustrate this a little further, I think I'm just giving you an example of a mocked up bank statement data for a business. So when you look at the first record, you can see it's a credit transaction of $18,000. But what you can do when you do transaction mining and transaction classification labeling is you will decode this as a human to say it's a loan which is received. So it's a new form of debt which the company is taking. When you look at the second record, you will see that it's also a merchant. They have a merchant relationship with Amex where they have taken payments for the sales of their products using Amex card. So American Express is making a settlement for the business. For the business this company has done, and it is providing credit to the business it has done, which is a charge volume, which is in some form the sales of the company, and so on and so forth. So you can look at every transaction and you can decompose this to say what kind of credit or debit is for a business, and then you can ask questions like What do you see in terms of usage of bank account? Do you see the business to be very stable? What does behavior on trades look like in terms of payments from suppliers or loans the customers take, business is taking? What kind of liquidity they carry, and so on and so forth. So you can derive a lot of intelligence by looking at this bank data, and then you can then use it to incorporate this intelligence in traditional modeling, which has a lot of other data sources to form an informed view on the business. The last aspect I'll talk about is probably with the advent of big data, AI, and ML and complex ML techniques, the amount of raw data we can consume and the intelligence we can drive has really exploded in financial services industries. And let me give an example. This is a time series view of transactions or events happening for a business. Let's say we're standing at time T, and when you were to look back in time, you can say at some point in time, I collected financials for this business. So I can form a view on what kind of EBITDA is this company having, what kind of debt ratios they can carry. So I can form this view, what happened 12 or 15 months back. Then I can see there is an increase in payments made by these businesses by looking at their commercial or consumer bureaus, and also the payments they make to American Express. Then I can see, given the business is growing and they are making good payments to their suppliers, there is an improvement in the commercial bureau, commercial profiles and commercial bureau scores. And now you can see the businesses looking for new credit so that they can expand their business. So by looking at this time series view, you can understand the severity of events, you can understand the frequency of events, you can understand the sequence in which this is happening, and you can also understand when this is happening, and you can make a much more informed view of what is the risk likely to be in the future. So by using this data, you can differentiate who is a growing business, who is credit worthy, that you can back those businesses and provide extended credit for them, who are businesses which are risky in nature that I should control for the exposures they can have with this. So this is something which really exploded. I would say looking at raw tail line level data and looking at time series data is probably where I think techniques like RNN and transformers has made a big difference to financial services industries, and it has enormously helped American Express to significantly improve our risk models and marketing services. So those are the three fundamental changes which has happened in our industry. Standing today, I still don't know what is going to happen. There are right now while the inflation in US is something which is at the lowest level in the last, I would say, 2-3 years, there is still an uptick in delinquencies which we see. The extent of debt we see in the market, both in individuals and businesses, and just the overall debt in US as a function of GDP is growing. There are concerns around stagflation and things like that. So as standing today, it's not clear. I think the expectation probably is the recession might be mild, it may be delayed going into 2024, but it is still at an uncertain environment for us, and hopefully, I don't know, probably in the next 12 to 18 months time, I may be back in this conference talking through a new trend which has emerged in risk landscape, and we'll probably talk about new innovations in AI and ML. Thank you for the opportunity, and I'll just probably pause now to see